Have you ever wondered how you can save money on your mortgage, reduce your exposure to currency fluctuations, or create a synthetic stock position without buying the actual stock? If you have, then you may be interested in learning about offset finance, a strategy that can help you achieve these and more financial goals. Offset finance is a term that refers to the process of counterbalancing or compensating for one financial transaction, contract, or investment with another that has an opposite effect. By doing this, you can hedge your risk, optimize your cash flow, and enhance your returns. But how does offset finance work? What are the benefits and challenges of offset finance? And how can you use offset finance in your financial planning? In this video, I will answer these questions and more. I will explain the basics and principles of offset finance, show you some real-life examples of offset, discuss the potential pitfalls and solutions of offset finance, and give you some tips and considerations for implementing offset finance in your financial plan. If you are curious and eager to learn more about offset finance, then stay tuned and watch this video till the end. You will discover a new and exciting way to improve your financial situation and achieve your financial goals. Let's get started. Offset finance is a term that refers to the process of counterbalancing or compensating for one financial transaction, contract, or investment with another that has an opposite effect. For example, if you buy a stock and then sell a call option on the same stock, you are offsetting your position. This means that you are limiting your potential gains and losses from the stock price movements. By doing this, you are hedging your risk and reducing your exposure to market fluctuations. Offset finance can be applied to various financial instruments and markets, such as stocks, bonds, options, futures, swaps, and currencies. The main goal of offset finance is to achieve a net position of zero, so that no further gains or losses are experienced from the original transactions. This can be beneficial for financial planning, as it can help you manage your cash flow, budget, tax, and debt more efficiently. But how exactly does offset finance work? What are the mechanisms and operational principles behind it? Let's look at some basics of offset finance and see how it can be implemented in different scenarios. One of the most common ways of offsetting is by taking an opposite position in the same or a similar instrument. For example, if you buy 100 shares of XYZ company at $10 per share, you can offset your position by selling 100 shares of XYZ company at $10 per share. This way, you are closing your position and eliminating any risk or reward from the stock price changes. You can also offset your position by selling a futures contract or an option contract on the same or a similar stock, as long as the terms and conditions match. Offset finance can also be used to create synthetic positions, which are combinations of different instruments that mimic the characteristics of another instrument. For example, if you want to buy a stock, but you don't have enough cash, you can create a synthetic long position by buying a call option and selling a put option on the same stock with the same strike price and expiration date. This way, you are replicating the payoff of owning the stock without actually buying it. Now that we have covered some basics of offset finance, let's look at some real-life examples of how it can be used successfully in different situations. One of the most popular examples of offset finance is the use of mortgage offset accounts. A mortgage offset account is a savings account that is linked to your mortgage loan. The balance in your offset account is deducted from your mortgage balance before interest is calculated. This means that you are effectively paying less interest on your loan and saving money in the long run. For example, if you have a mortgage loan of $200,000 with an interest rate of 5% and an offset account with $50,000, you will only pay interest on $150,000. This can reduce your monthly payments and shorten your loan term significantly. Another example of offset finance is the use of currency hedging. Currency hedging is the practice of reducing the risk of losing money due to unfavorable exchange rate movements. For example, if you are a US-based company that exports goods to Europe, you are exposed to the risk of the euro depreciating against the dollar. This means that you will receive less dollars for your euros when you convert them. To hedge this risk, you can enter into a forward contract or a futures contract that allows you to sell euros and buy dollars at a predetermined exchange rate in the future. This way, you are locking in your profit margin and avoiding any losses from currency fluctuations. These are just some of the examples of how offset finance can be used in real-life situations. The key takeaways from these scenarios are: offset finance can help you save money, reduce risks, and optimize your investments by counterbalancing or compensating for one financial transaction, contract, or investment with another that has an opposite effect. Offset finance can be applied to various financial instruments and markets, such as stocks, bonds, options, futures, swaps, and currencies. Offset finance can be achieved by taking an opposite position in the same or a similar instrument, taking a position in a different instrument that has a negative correlation with the original one, or creating a synthetic position that mimics the characteristics of another instrument. Offset finance can be used to create mortgage offset accounts, currency hedging, swap contracts, and other strategies that can benefit you in different situations. However, offset finance is not a perfect solution for every financial problem. There are some challenges and drawbacks that you need to be aware of and mitigate before using offset finance. Let's look at some of the potential pitfalls and how to address them. One of the main challenges of offset finance is the cost involved. Offsetting your position may require you to pay fees, commissions, spreads, or premiums to enter into a contract or a transaction. These costs may reduce or even eliminate the benefits of offsetting. For example, if you buy a call option and sell a put option to create a synthetic long position, you may have to pay a higher premium for the call option than the premium you receive for the put option. This means that you are paying more to enter into the position than the potential profit you can make from it. Another challenge of offset finance is the risk of imperfect offsetting. Imperfect offsetting occurs when the offsetting position does not fully cancel out the effects of the original position. A third challenge of offset finance is the opportunity cost involved. Opportunity cost is the value of the next best alternative that is foregone as a result of making a decision. By offsetting your position, you may be giving up the chance to make more money or gain more benefits from another position or strategy. For example, if you buy a stock and then sell a call option on the same stock, you are limiting your potential gains from the stock price appreciation. You may be better off holding the stock and enjoying the full upside potential. These are some of the challenges and drawbacks of offset finance that you need to consider and mitigate before using it. Some of the strategies to address these risks are: compare the costs and benefits of offsetting your position and weigh them against your financial goals and risk tolerance. Choose the option that maximizes your expected utility and minimizes your expected loss. Match the terms and conditions of the offsetting position as closely as possible to the original position. Use standardized contracts or instruments that have similar features and values. Avoid exotic or complex instruments that may have hidden risks or costs. Diversify your portfolio and hedge your exposure to different sources of risk. Use multiple instruments or strategies that can offset each other in different scenarios. Do not rely on a single instrument or strategy that may fail or backfire. Monitor the market conditions and the performance of your offsetting position. Adjust your position or exit your position as needed to maintain your desired level of offsetting. Be flexible and adaptable to changing circumstances. Offset finance is a complex and fascinating topic that can offer many benefits and advantages for your financial planning. However, it is not a magic bullet that can solve all your financial problems. You need to understand the principles and practices of offset finance, weigh the pros and cons, and implement it wisely and responsibly. I hope you have enjoyed this video and learned something new and useful about offset finance. If you have any questions or comments, please feel free to leave them below. I would love to hear from you and answer your queries. And if you liked this video, please give it a thumbs up and subscribe to my channel for more videos on financial topics. Thank you for watching and see you next time.